Should you have bonds in your retirement portfolio? If so, how much? If the equity portion of your retirement portfolio declined by 42% over 9 months, would your retirement be ruined? Hi, my name is JP Geisbauer, founder of Centerpoint Financial Management. I'm a certified financial planner professional, a certified public accountant, and this channel is dedicated to helping diligent savers maximize their lives and minimize taxes as they transition into retirement. Okay, let's dive into this example. In this example, we're going to look at portfolios that consist of two securities. For stocks, we're going to use the Vanguard Total Stock Market Index Mutual Fund. And for bonds, we're going to use the Vanguard Total Bond Market Index Fund. This isn't a commercial for Vanguard, but they have been doing this a very long time. And so using these two securities allows us to have a long track record. So we can actually run through this analysis with these two positions, and we're actually using the true data for the last 25 years. Now, there are only two securities within these portfolios, but because these are index funds, the holdings within the mutual funds mimic the underlying index. So last time reported, the equity fund had over 3,600 positions and the bond funds had over 11,200. So even though there are only two securities within this portfolio has broad exposure to the US bond and equity markets. So let's take a look at the composition of the equity fund. You may notice this as the Morningstar style box, which basically shows the composition of the portfolio, but broken down between value and growth, large cap, mid cap, and small cap companies. So if you look at this box, you'll notice that this fund is predominantly a large cap blend fund, but does have some exposure to mid and small caps as well. Now let's take a look at the sectors. Now, you'll notice that these are the same thing side by side. This is because this is the only fund that we're using for these different portfolios. So these are essentially the exact same thing. But if you look at this fund, it's predominantly technology, right? There's about 31% in technology. But it also has all of the other sectors like industrials, energy, communications, real estate, financial, consumer cyclicals, basic materials, utilities, healthcare, and consumer defensive stocks. So again, while this portfolio only has one equity mutual fund in it, because of its composition, we see that it has wide exposure to the various sectors of the equity markets. And finally, let's take a look at the actual individual holdings. Now, this software is able to look through the wrapper and see the actual individual holdings of any particular mutual fund. So you'll notice that the top 6 positions are very well-known technology stocks. Now, I did the arithmetic here, and these 6 positions account for about 27% of the entire portfolio. Now, this could possibly be a concentration risk. Now, the topic of concentration risk is outside of the scope of this particular video, but I will be addressing it in future videos. If you want to make sure that you don't miss those, make sure you hit like or subscribe so you'll be notified when new videos are released. Okay, so that basically summarizes what we're looking at from our equity position. So let's take a look at the composition of our bond fund. Now, we're not going to get too far into the weeds in here, but there are basically 2 characteristics that I want to point out. Number 1, the overall credit quality for this particular bond fund is AA, which is very high. And the average duration for this bond fund is about 5.97. So that puts us basically in a duration that's considered intermediate term for bond funds. Now, it's important to point out that not all bonds are essentially the same. What we're dealing with this particular bond fund is high quality and intermediate term duration. Not all bonds are necessarily the same. So just because something is a bond doesn't necessarily mean that it's not risky. For example, bonds with long duration, bonds with lower credit quality, what are often referred to as junk bonds, emerging market bonds, convertible bonds. All of these types of bonds can add a tremendous amount of volatility to a portfolio. But because this particular bond fund is high quality and intermediate term duration, it's considered on the more conservative side. So now that we've got our arms around what these funds are, let's take a look at how they've performed over the last 25 years. So first, let me kind of walk you through how we broke down these 4 portfolios. The top portfolio is 100% stocks and 0% bonds. Again, using those 2 funds that we talked about earlier. The next portfolio we're going to have is 65% stocks and 35% bonds. The next portfolio is going to be 35% stocks and 65% bonds. And finally, we're going to have one portfolio that is no stocks and 100% bonds. So what we have over here on the right is the performance of these four different portfolios. The highest performance portfolio was the all stock portfolio, while the lowest performing portfolio was the all bond portfolio. So if you look at these charts and you see how well equity performed, you might say to yourself, I would definitely be 100% in equities. Look how much better the portfolio performed. What this would entail is you stuck with these portfolios throughout the entire duration of these 25 years, meaning you never deviated from this. If you were all stocks, you were all stocks the entire 25 years. If you were all bonds, you were all bonds for those 25 years. And if you were one of those two portfolios that had the 65-35 or 35-65, you maintained that throughout the entire duration. But I want to show this to you in a different way. Now, here are the 6 significant downturns that occurred within that 25-year period. We've got, the tech wreck of the early 2000s. We got the subprime crisis of 2008, 2009. We've got the debt ceiling crisis of 2011. That was when the US government was threatening default on their debt. We have the 2018 rising interest rates and trade disputes crisis. This particular downturn here represents coronavirus. And this final downturn is 2022, when both stocks and bonds really got beat up with the rising interest rates and the threat of inflation. Remember at the beginning of my video where I said, would you be able to sit still if your portfolio lost 42% in 1 year? That wasn't necessarily a theoretical. That's actually happened in history. So let's think about that for a second. 42%. So say you have $1 million portfolio and 9 months later, it's somewhere between 570 and 580. Now you have to have a gut check here. Would you really be able to sit through and really deal with that so that you could get that performance that we saw in the all equity portfolio early on? Or would you be tempted to sell and say, hey, look, I've already lost this much. I don't want to lose any more. If you were around in 2008 and you remember just how scary those times were, you probably might have been tempted to sell all of your equities. I mean, if your equities dropped by 42% and you're a retiree, that's terrifying. So that's why by having something that's 65% stocks and 35% bonds, you lost, I want to say only here, but you only lost 27% compared to the 42% of the 100% stocks. Where if you went to 35% stocks and 65% bonds, you lost around 14%. And if you were all bonds, you actually eked out a little return in that particular time period. So this is why having bonds as a portion of your portfolio can be very important. It's easy to look at this performance graph and say, oh yeah, no problem. I definitely could have stuck with this throughout the entire 25 years. But when you look at what the actual downturns look like, and you think about a 42% decrease in your portfolio because it was all stocks, you might start to have a different feeling. This is why, if you are a retiree, you may want to start adding bonds to your portfolio. Now, to be clear, I'm not saying that I anticipate the equity markets to drop by 40% anytime soon. I'm just trying to illustrate the point that an all equity portfolio can be very risky. The history bears that out. So if you've been heavily weighted into equities and are approaching retirement, you may want to reconsider what role bonds will play in your retirement portfolio. So what do bonds do? Number 1, provide stability and reduce volatility. Bonds tend to be less volatile than stocks, providing stability in a portfolio. As people near retirement, they often seek to preserve capital rather than chase returns, making bonds an appropriate option. Number 2, risk management. As people approach retirement, they'll typically reduce their exposure to high-risk assets. Bonds offer a lower risk alternative to equities, which is important to protect the value of the portfolio in a market downturn. Now, it's important to reiterate here that not all bonds are the same. Make sure you understand the credit quality, duration, and nature of the bonds you are using to achieve these goals. Number 3, diversification. Including bonds helps diversify a portfolio, reducing risk by spreading investment over several asset classes. When stock markets decline, bonds tend to act as a counterbalance because they tend to perform better in such environments. Number 4, capital preservation. For investors nearing retirement, maintaining their savings becomes critical. Bonds are generally seen as safer investments that can help preserve wealth. Number 5, income generation. Bonds provide regular interest payments, which can be a reliable source of income. which is especially important for retirees that are looking to replace their salary with predictable cash flow. So what is an effective way to begin to position bonds within your portfolio? Well, let me show you. Here is an example of a glide path. We see the percentage of the portfolio totaling 100% on the left and the investor's age on the bottom. The purple area is the percentage of equities. The green is the percentage of fixed income, also known as bonds. And the orange is the percentage of cash. Now, this example is more to reinforce the glide path concept. This is not an investment recommendation. It's important to note that while the glide path provides a general framework, individual investors should consider their personal circumstances, cash flow needs, risk tolerance, health, anticipated lifespan, and financial goals when determining their optimal asset allocation glide path strategy. So make sure you take all of these factors into consideration when deciding what your ideal glide path should be. So as you can see, over the years, the investor rebalances the portfolio into bonds to get to the desired equity exposure. It's not just all of a sudden that the investor goes from 60% equities down to 30% equities. Doing this over an extended period of time can help you plan out the income tax consequences and mitigate the sequence of returns risk. Your ideal asset allocation glide path strategy should be a part of your comprehensive financial plan. I did a video on how to create a comprehensive retirement plan. You can watch that video here. Well, if you made it this far, thanks for watching. If you enjoyed this content, please hit like or subscribe. Thanks again for watching, and I'll see you next time.